Uh, Hello and welcome everyone. On behalf of Accounting Standard Board of ICAI, I take pleasure to welcome all viewers, esteemed guests, and participants in the virtual outreach on the better communication in financial reporting for deliberating on exposure draft issued by the International Accounting Standard Board on primary financial statements. The objective of this reach out is to apprise users, preparers, and other stakeholders besides the chartered accounting fraternity of the latest development on IASB front, and also very importantly to seek their views, thoughts on the proposed changes. And we are very eager to hear your views and ideas, and so that we can forward in turn as the second largest accounting body to IASB. It's our onus, it's our responsibility to contribute as much as we can, and that ICI Accounting Standard Board can do only when you all, when I say you all, means all the users, preparers, other stakeholders, and the SRIA fraternity take an active interest and write to us their views and thoughts on the proposed changes. Friends, today's session has been divided into four parts. One is the technical introduction, then the technical discussions, followed by two panel discussions. A lot many changes have been made in the proposed IFRS 6, which is going to replace the IS1. I don't want to divulge all this now because there are galaxy of the stalwarts and the experts and the domain experts. We're going to share everything in a short while from now. So, to kickstart the program, I invite uh, Accounting Standard Board Chairman Sri MP Vijay Kumarji to share his views and to give the welcome address. So we welcome Accounting Standard Board Chairman Vijay Kumarji.
Thanks, Ignesh.
My pleasure.
Good afternoon, everyone. I wish you well during this challenging time and sincerely hope everyone is staying safe. It's my honor and privilege to welcome our Honorable President, who should be joining us anytime soon, Honorable Vice President, Sri Nihar Jambusarya ji, and my council colleagues for this virtual outreach. I acknowledge the presence of my learned Vice Chair, Accounting Standards Board, Sri Sanjukumar ji, proficient panelists, members, and industry participants. Thank you to each and every one of you for being here with us today. The Accounting Standards Board has always believed that India's framework enhances the quality of financial statements of Indian entities and strengthens their competitiveness and comparability on global platforms. To continue to achieve this global level playing field, there's a need for us to actively participate in the International Accounting Standard Board's standard setting activities. In this regard, it is worth mentioning that IASB invariably responds to all the consultative documents issued by the International Accounting Standards Board. Whenever IASB proposes any new IFRS or issues any proposal of high significance, including discussion papers and through IFRIC tentative agenda dations, IASB, apart from issuing ED on the proposed standards and other consultations, holds meetings to reach out to stakeholders to understand their perspective on the proposals. With this thought process, this virtual outreach event on IASB's exposure draft on general purpose or general presentation and disclosure primary financial statements has been organized. The present form of income statement has been around for a fairly long time, and from a global perspective, the presentation has not been really consistent across jurisdictions and entities. In India, of course, we have Schedule 3, which gives us a template which ensures a bit of consistent presentation. But we have experienced that most managements prefer to explain their performance with various subtotals and descriptors of operating performance like EBITDA, adjusted operating profit, free cash flow, etc. And investors, users of financial statements also have these expectations. Financial statements have to serve the purpose of effective communication between preparers and users. The exposure draft of general presentation and disclosure, primary financial statement, seeks to address this gap. It is extremely important that financial statements stay relevant for us as professionals. Else, it will become a mere compliance requirement and the preparers and users will find alternative communication mode. Overall objective of this IASB's project is to address the concerns of the users with regards to transparency, comparability, and performance reporting by further improving the presentation and disclosure aspects in financial statement. The exposure draft proposes to replace IAS 1 presentation of financial statements with a new IFRS to be titled as General Presentation and Disclosures. The proposed presentation is truly transformation. In particular, there will be a tectonic shift in the line items to be presented in the statement of P&L. Other important aspects dealt with by the exposure draft are strengthening the requirements for disaggregating information, inclusion of relevant information regarding management performance measures that are used by many entities to communicate management's views on entities' performance to various stakeholders. The deadline for submitting comments to IASB is 30th of September 2020. This is the extended deadline, which initially was 30th of June 20. And IASB will consider the feedback on the exposure draft in developing its final requirements. In order to enable Indian entities to derive benefits of globally understandable and acceptable financial statements using globally recognized financial reporting standards, it is important to remain IFRS converged, and therefore consequential change in Ind AS 1 presentation of financial statements will also be made in Indian context in due course of time after finalization of its proposals by the IASB. Further, these proposals would affect various regulatory formats such as Schedule 3, XBRL filing requirements, and the formats which are issued by SEBI for interim financials and Reserve Bank for the banking system. Therefore, it is very important that these proposals are analyzed in sufficient detail. The IASB is also undertaking an exercise called field testing, wherein the interested entities would perform a dry run by preparing pro forma financial statements using the prescriptions of the exposure draft and provide their feedback based on this experience. So ASB has conducted a virtual meeting with CFOs and senior finance professionals a few days back on the 19th of June with the support of ASHACHAM. Thanks to Dr. Ashok Hardia in enabling that meeting, who is incidentally also agreed to be a moderator of panel 2, and thankful to him for the same. This program is structured in two parts, namely panel 1 to deliberate on the key changes in the structure and contents of mandatory general purpose financial statements, which will be moderated by my council colleague Pramod Jain ji, and panel 2 to deliberate on disclosure of non-GAAP and GAAP measures by the management of the entity. The key objectives of the webinar, as Yagnesh mentioned, is to disseminate the key aspects of the proposals in the exposure draft for the understanding of the stakeholders. And secondly, and importantly, to identify and analyze the impact of these amendments in Indian context, considering that our local legislations also do prescribe formats under different statutes. I am sure that the thoughts and insights of our eminent panelists would enlighten the participants. Very thankful to the President and the Vice President for their continued support to the activities of the Accounting Standards Board. Vice President has himself been a chairman of the INDES Implementation Committee for a few years and has championed the cause of a very smooth implementation of INDES in the country through the INDES Implementation Committee. Thankful that he's been able to take his time today and be here. And President has been leading the overall initiatives of the Institute to be globally relevant, and thankful that he is also agreed to be here today and address us. Looking forward to an enriching event ahead. Happy learning. Stay safe and stay healthy. Over to you, Agnesh.
Thank you, Chairman Sir Vijay Kumarji. And friends, now we must be ready to be vocal about the local issues as suggested by our Chairman IASB. So be prepared and make notes that let us express our views, Indian condition and all this. And thank you very much, sir, once again. And now it's my turn to invite the Vice President, CA Nihar Niranjan Jambusariya ji. Welcome, Nihar ji, and please share your thoughts and the welcome address, sir.
Thank you, Yagnesh. Good afternoon, everybody. Honorable President in absentia, he would be joining anytime perhaps. The Chairman of Accounting Standard Board, CAMP Vijay Kumar, Vice Chairman CS Sanjeev Singhal, the two very able moderators of the two panels and the council members, the panelists and the viewers. Let me at the outset compliment the Accounting Standard Board for coming out with this outreach program at the very right time. This outreach program is on primary financial statement exposure draft of the IASB, and the title is Better Communication in Financial Reporting. This perhaps is the objective of IASB. I was just glancing through this exposure draft, although I did not have opportunity to go through in detail. And I was seeing that probably IASB is trying to achieve more uniformity in the presentation of primary financial statements. And although the title is Primary Financial Statements, I think major thrust in the exposure draft is given to income statement rather than balance sheet or cash flow. And certain new concepts of removing certain options, rebundling certain heads, introducing new heads. I think that is the attempt of IASB in the attempt to achieve uniformity. I see interest and dividend paid. It is proposed that it will be treated as financing activity. Interest and dividend received will be treated as investing activity. The options which were available so far, this exposure draft seeks to remove. There are many new terminologies like unusual income and unusual expenditure. It will be interesting to understand from the panelists and faculties today, and it will be interesting when the stakeholders would give their inputs on the new proposals. Apart from this, the new phrases which are used are integral associates and JVs, non-integral associates and JVs. These are certain new terminologies which the exposure draft is using and explaining. and a fairly new concept of covering MPM, management performance measures. This is an item beyond financial statements, but still, for the first time, an accounting standard is making an attempt to cover it. I think it is very interesting and it is going to generate a very good discussion today. And the objective of ASB, I think, will be achieved if the stakeholders not only make an attempt to understand this exposure draft, but also apply their mind and give their inputs. The chairman ASB very rightly mentioned that in India we have different formats prescribed under different statutes. So how will this exposure draft be in contradiction to that, and how do we achieve uniformity, or how do we report and comply with both those formats and the standard whenever it is finally implemented? I understand that once IASB comes out with the new standard, our ASB will have to incorporate that into Ind AS and seek approval of MCA. I compliment today morning, I understand the changes related to COVID-19 in Ind AS 116. Related rent concessions have been discussed with NFRA and perhaps have been finalized. And in the afternoon, we are discussing a new exposure draft. Amidst all hectic activities of ASB, that is framing new standards, conducting programs on ASB, holding certificate courses, preparing educational material, and this year the Ind AS Implementation Committee, whose responsibility was given to me last year, has been merged with ASB. So ASB is burdened with two committees' activities, and in the midst of so much of pressure, you have been able to organize this outreach program at the very right time when we need to give our inputs. And last point I would like to mention, that we must on every exposure draft give our inputs to IASB and demonstrate our interest and participation in standard setting activity. We are 10% of the world's accountants population, Indian chartered accountants, and we must have active say in the standard setting activity of IASB, so that when Ind ASs are framed, we do not have many apprehensions about how to implement this or that and think about carve-outs. With this, I thank the chairman and vice chairman of ASB for giving me this opportunity to interact with you. And I'm sure that we will have excellent session today, and our inputs to IASB will go in time. Stay safe and stay healthy. Thank you so much. Back to you, Yagnesh.
Thank you, Vice President Ji. Thank you so much more so for giving tips of what is new and what are the new phrases and what are the new changes in a brief and in a very succinct manner. Uh, 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 I'm sorry to say that our President Sir is trying his best to reach, but somehow he's unable to join the forum just now. So, in his absence, I would now invite in his absence, I'll now invite the Vice Chairman of Accounting Standard Board, C.S. Sanjukumar, Dr. C.S. Sanjukumar Singhal, for his remarks and for the vote of thanks for the chief guest. So, Dr. Sanjeev Kumarji.
A very good afternoon to you all, and I really thank CA Yagnesh Desai. Yagnesh, by you are known for your unique style, and I'm really happy that you are the MOC today. So at the outset, my thanks to my chairman, MP Vijay Kumarji, and of course our honorable Vice President Nihar Bhai, as we call him. The way he has summarized the whole issues that we are going to discuss is amazing, and that clearly reflects that he was the chairman of the India's committee last year. So that experience is truly reflected. He summarized that we are talking about EBITDA, cash flows, unusual income, integral and non-integral associates and JVs, and the non-GAAP measures. This really amazing, Nihar Bhai. that you have summarized the whole issues that we are going to talk about. And I'm extremely thankful to my two moderators, CA Pramod Jainji, my honorable Central Council colleague, and Dr. Ashok Kaldia, who is always a delight to listen to, and my extreme panelist, Mr. Shankaraya, with whom I had the opportunity to work for 5 years in Jubilant Life Sciences. P.R. Ramesh sir, of course, he is again a powerhouse of knowledge. We all know him, and his contribution to the institute and to the profession as a whole is simply unparalleled. And Rakesh Agarwal, who is a member of my sustainability reporting standard board also, and he has been really instrumental in 2 of the webinars which we recently did. Uh, and Mr. Sadhendu Datta from ITC, who will also be joining us shortly in panel 1. So this is really a great occasion, and this is happening in the middle of COVID-19. We all are facing this issue, and these virtual meetings have become the order of the day. And this is really great to see that learning has not stopped. Rather, the scope has simply increased because people can join from everywhere. None of us had to travel for this program. If this was happening in a physical mode, I don't know how many of the panelists or the moderators we've been able to get. This is really, really difficult. Now it saves so much of time, and the effectiveness is also increased. So, as was rightly mentioned by the chairman MP Vijay Kumar and Nihar Bhai, Accounting Standard Board is taking this initiative, and it has been our endeavor that we participate in all the activities of the International Accounting Standard Board, and rather actually participate, actively participate, and give our feedback in time. And this topic is the topic for the day is very important: primary financial statement. And as Nihar Bhai rightly said, that mainly addresses the statement of P&L, but yes, it partly covers cash flow statement and the other disclosures as well. But yes, mainly talks about the statement of P&L. We have seen in various investor presentation, and since Mr. Shankaraya is here, he knows it the best, that while making presentation to the investors, various non-GAAP measures are used, adjusted profit and then EBITDA and other terminology. So users were finding it difficult to reconcile these things. And now if some of these concepts are being included in the statement of P&L, that will be helpful. And similarly, the proposal to give the non-GAAP measures in the notes to the accounts, and I hope these come with a reconciliation to the GAAP measures. These will again be helpful. There are proposals relating to the cash flow statement. In a way, in our Ind AS, uh, we have done the curtailment of option for the presentation of interest and dividend received and paid. Now these are classified in the cash flow statement as investing activity in case it's a receipt of interest or dividend, and as a financing activity if it's a payment of interest and dividend. IASB is trying to come closer to Ind AS, not fully. Uh, Rather, my recommendation would be that if we can remove these options, that will help in the uniform presentation of the financial statements. So overall, this is a very important topic, and I thank all my council colleagues, the president in absentia, the vice president, and all the panelists for sparing their time and the valuable uh, audience, because your feedback is going to be very, very important. So looking forward for a great discussion ahead, and I would like now the MOC Yagnesh Bhai to take over. Thank you very much. Thank you.
Thank you, Dr. Sanjeev ji. बहुत बेहतरीन था. Very good information and very good dissemination of information by you as usual. All right, very good. Friends and all viewers, you must realize something, that time and again, all the stalwarts, all the chairman, vice chairman, and vice president, all of them are emphasizing only one thing in common, and that's they are interested in knowing your views so that we can then, as the world's second largest accounting body, make our presence full and international arena. Having heard a lot about there's going to be paradigm change, there's the new phrases, the new way of presentation of the financial statements. I know now you're all keen to know in technical details as to what these really means are. Am I right? जी हाँ बहनों भाइयों, अब आपके सामने they are going to give you in great detail, and that is by none other than CA Vidyadhar Kulkarni, Head Technical Directorate, and I'll invite him to deliberate and dwell upon the technical discussions on the overview of IASB proposals. IFRS X is the code name of the new proposed standard, and which is, and when accepted, is going to replace the present IAS1. So I welcome Vidyadhar to please deliberate and debate on the on the proposals proposed on the exposure draft. So kindly unveil the draft, and we are all very keen to see your presentation, sir. Welcome.
Yeah. Thank you, Ignesh. I would be next sort of 45 minutes or so. I will take you through some of the overview of the technical aspects of this proposal, and at the outset, I would like to thank the President ICAI and the Vice President ICAI and the Chairman Accounting Standard Board, and then the Vice Chairman Accounting Standard Board for giving me this opportunity to actually share the technical aspects of this important development, where like other panel speakers said, that internationally it is important for us to actually participate in these events at the standard setting stage itself, so that our views and our contribution is also there globally. So with this initial remark, I will take you through some of the sort of the important changes which are there, and of course, as you know, there are two panel discussions, very important, and we have a very eminent the panelists who are really experts in this subject, and they will actually deliberate in detail the sort of pros and cons of these the proposals which are made, and then it will be one of the important initial stages for us to actually put forth our very well considered and debated views to the International Accounting Standard Board, the IASB. So what are the next 40 minutes or so, what are the things I will be covering? Basically a quick overview of what is this better communication in financial reporting, this entire project is, what are the components there, and then within that there is an important component relating to primary financial statements, and then within that there are 5 or 6 items which are important ones, like what are the new subtotals, new categories in statement of profit and loss count, and then what are the line items for share of profit and loss of associates and joint ventures. And there is an important area which is also, which we are all interested in knowing, is about how to present the fair value gains and losses of derivatives and hedging instruments, and then disaggregation of information in notes to accounts. And then another important item is unusual income and expense. And then the another very important topic is also of the management performance measure, or sometimes it is also known as alternative performance measures. And then as a consequence of these proposals of changes to replacing the IAS1, there are also consequential changes in other IFRS standards. So quickly, I'll also give an overview of that. And then with these proposals, then what's our next steps from the stakeholders' point of view? What are the sort of areas where we'll have to contribute? So that's another area which I'll deal with. So now, very quick introduction of this entire project, which is really nicely actually titled or christened as Better Communication in Financial Reporting. As we all know, there is IFRS standards, which are the basis of Ind AS. There is a very comprehensive, robust, framework of financial reporting. But about the, it talks about recognition, measurement, presentation, and disclosure. But one of the important aspects is also all those recognition and measurement principles, etc., have to be actually communicated to the users of financial statements. So that's why one of the idea is that how better the communication can happen through financial reporting. So in this, there are three important projects which at IASB level they have. One is about the primary financial statement, which talks about the statement of profit or loss, balance sheet or statement of financial position, and statement of changes in equity, and then the notes. And the another initiative was about the disclosure initiative. And then another project is the management commentary. So these are the contents part of it as part of better communication finance reporting, and the delivery of that at the IFRS standard level. The tool is IFRS taxonomy. In India, we have a XBRL taxonomy, we call it, which has Ind AS taxonomy, and then there is for AS entities also there is a taxonomy. So, but today's this proposal, the exposure draft, is all about this one item which I have highlighted here. That's about the primary financial statements. So now let us see what's the background of this project at IASB level and what are the key changes. So why this project, the IASB took it up, an important area to know for us, is one of the thing was there was quite a wide diversity of, in the reporting terms used or in the reporting lines which were there. There were somebody presenting gross profit or loss, somebody calling it operating profit or loss, and some entities not giving any name at all. So that was, and then certain areas were called as the statutory measures and non-statutory measures, and some areas like which are more alternative performance measures, which were where they EBITDA or EBIT or free cash flows, which were actually terms used and actually presented also. Of course, in the profit and loss account also other areas were there, certain line items, etc. Somebody used to use a term called turnover, somebody will use revenue, somebody will use something else, interest income or something less, or a trading income. So there was the users of financial statements were also having concern about what all these different kind of items mean by when they're presented by different entities. I hope I am audible. And now let me come to the key proposals and what are the expected benefits and why it was done. See, one of the there are four important things in my view. This the key proposal which is trying to achieve, and there were four reasons for that. One was the structure and content of statement of profit or loss account varied between different entities, and that's why the users were finding it difficult to compare entities performances. So that's why the proposal is that yes, let us have a defined subtotals and categories. In next few slides you will see that what are those proposals which are given and which are those subtotals, what are those categories. And another area was level of aggregation. So meaning in the notes to accounts or in the main financial statement component itself, the aggregation or disaggregation, there were concerns. That's why the proposals are to strengthen the requirements, basically laying out certain principles on when you have to disaggregate information or aggregate. The principles have been given in the new standard, proposed you can say proposed exposure draft. And the another area which which is actually very widely talked about and everybody was actually considers this area important, but they wanted to have certain kind of a discipline around that. That's the non-GAAP measures. Many entities, these could be of financial measures, or this could be non-financial as well. Like somebody, like, free cash flow, is presented, and somebody used to, some entities present some different kind of a financial ratios, and there are also entities which also used to present as non-GAAP measure certain adjusted, profit numbers. So what the proposal now is there will be a definition of what is called as a management performance measure and where this need to be disclosed. So that is the proposal. And another important area outside of this presentation of financial statements, an important area is in the statement of cash flows. There also, there were, internationally, a couple of options available, especially with reference to interest, dividend, these kind of items. So there is now, there is a refinement and a new proposal which actually, removes those options for, especially for the non-financial entities like manufacturing entities and trading entities. So that's going to expected to have improved comparability among the entities. Now, before I go into little more detail of each of those proposals, which I just spoke about just now. Now, what is the approach the IASB is taking for making these changes? Basically, as we all know that there is one standard, IFRS standard, IAS1, presentation of financial statements, which is the one which is going to get affected by these proposals. So how are those going to be, how is getting affected, and what changes is happening? Primarily, large portion of this standard is getting replaced with a new standard, which our master of ceremony mentioned, IFRS XX, which will be called now General Presentation and Disclosures. And already the exposure draft was issued by IASB in December 2019. So it is, you can say that it's almost now 6 months old. And some of you are also, have read it, and some of you might be familiar, and we have also formed certain views as of now. And then another area what this is doing is some portion of this IAS1, especially relating to the basis of preparation, going concern, and these area compliance with the standards when preparing financial statements, they are getting relocated to another existing standard, which is IAS8, which is about the accounting policies, changes in accounting estimates and errors. And then there is another area is there are certain standards which are actually other IFRS standards which are getting affected. And these are 6 standards which are there, statement of cash flows, and then the IAS8, and then earning per share, interim financial reporting, then IFRS 7, financial instrument disclosure, and then IFRS 12, which is about the disclosure of interest in other entities. So in the later slides, I'll actually summarize what those changes are also happening in those standards. Now, as far as the first change that's happening in the primary financial statements is basically now there is a new term which is coming into picture, that is primary financial statements. So you would say that what does it comprise of? Now, primary financial statements, it is defined now as statement of profit or loss, then statement of financial position. In India, we call it balance sheet, and then statement of changes in equity. These are called primary financial statements. And you all know that there is another component which is there in IAS1, that is the notes to financial statements. So that is not a primary financial statement. Of course, that is also equally important. And then the proposal also contains what is the role of that notes and what is the role of this primary financial statements. Now, coming to the primary financial statements, what are the changes that are happening? As one of the earlier speakers mentioned, that largely among the components of financial statements, which is the one which has got affected the most, or you can say the biggest, that is the statement of profit or loss. And in that, now next 15 minutes or so, I'll be talking about what are the changes that are being proposed in that. So basically, in the statement of profit or loss account, there is going to be now a prescription for a mandatory 3 subtotals. One is on this slide, you will see operating profit. And then there is a next subtotal will be operating profit and income and expense from integral associates and joint ventures. And then after that, there will be profit before financing and income tax. Of course, at the end, you will also have after income tax profit for the year. So these are the 3 new subtotals which are coming. Some of you might say that, yes, some entities were already presenting it. So what's the big thing about it? The point is, some were presenting, some were not presenting, because IAS 1 did not have any mandatory line items other than net profit before tax and after tax. So that's why these 3 new items have been proposed. And now, what is the other next change which is also proposed? In the statement of profit or loss, there will be the all income expenses. They will be classified into 3 categories. There will be 3 categories of classification. Some of these titles of these categories you are familiar with, because these are used in statement of cash flows. One is the operating category, and the second one is investing, and the third one is the financing. So very briefly, I'll explain you about these terms, and during the panel discussion, obviously we'll have a much more sort of a detailed sort of a discussion around what do they mean, how what do these terms mean, and are there any issues around that, or these are acceptable. The first one is operating. It talks about the standard says that the information that will be presented in this operating category, the income expenses. And once again, I'm mentioning to you, this categorization is with reference to the statement of profit or loss only. It is not with reference to balance sheet or statement of financial position, only with reference to profit or loss. It is operating category includes information of income expenses from an entity's main business activities. Yes, this sounds very nice, but at the same time, it also says that the items which are not classified in investing or financing, they also need to be included. So it becomes includes one portion is the items relating to entities' main business activities, and plus a residuary category type of a thing of something which is not classified in other 2 categories can also come here. Then now going into investing category classification, what is the criteria? It lays down, it is actually the objective of this category is to communicate information about returns from investments that are individually and largely independent of other resources held by the entity. In the next slide, I'll just give you a couple of examples of which are those items. And then the financing activities is about the objective of this category is to communicate information, that is the income expenses from assets and liabilities relating to the entity's financing. So these are the sort of you can say the definitions which are kind of a definitions which are actually prescribed under the proposed standard. And apart from that explanation of that operating category and investment category, only in case of the financing activities, the proposal actually goes around and also tries to further explain this or define what these financing activities are supposed to mean. Financing activities are supposed, they say that it is involving, financing activities are those that involve receipt or use of resources. It means it is from both borrower side and the lender's side. Receipt or use of resources from a provider of finance with the expectation that the resource will be returned to the provider of finance, and the provider of finance will be compensated through a payment of a finance charge. This is how it is defined, what the financing activities. Now, based on this description, as you know, operating categories, the criteria which has been laid down, more or less we come to know that yes, what all it includes is, it will include basically income expenses relating to main business activities, and the entity's management has to have a discretion in deciding which are those main business activities. And the second category, investing activities, it is like, for example, what all it's going to include. It's like, for example, globally there is, for investment properties, there is a fair value option is also available. So fair value changes in that investment property. Then if you have entities have a investment in some shares of another entity, or if they have given a loan to another entity, so there will be dividend income will be there, or interest will be there, that will get covered under investing. And another important point for all of us to know is, it is not just the income to be classified under the investing category, the incremental expenses incurred in generating this, not all expenses, incremental income only. Incremental expenses incurred in generating these investing activity income will also be considered as part of this investing activities. And the financing category, the third category, which includes income expenses from cash and cash equivalents. And what are the cash and cash equivalents? These are defined in statement of cash flows. We have to use the definition. And income and expenses on liabilities arising from financing activities. And now specifically it has brought in when it comes to the certain items where there was a clarification required. Basically, for example, unwinding of discount on pension liabilities, or unwinding of discount on decommissioning liabilities. Should it be financing, or where should it be shown? In the standard, in the proposed standard, this is clarified that this will form part of the financing activities in the statement of profit and loss account. Now, you might say that, how does this compare with these activities or the three categories which are already defined in statement of cash flows? Yes, you can see on this slide, the wordings used in statement of cash flows, IAS 7, continue as it is, with a very limited change in investing activities. And you will see that yes, in all of these three categories, there is wordings are different. But yes, I would not comment at this stage on what should have been the approach. Should we use this existing definitions, or these new definitions are better? That will be, we can debate and deliberate as part of the panel discussion. But I would say that the wordings are different. And with reference to investing activities, I see there is some definitely a disconnect between the definition in IAS 7 and what is there in the proposed exposure draft. In other two areas, I do not see much difference, but I will leave it to the panelists and you all to actually deliberate in detail. So these are the three new categories. So we have seen in statement of profit and loss account two important changes that are happening. One is three new subtotals which are coming, and then three new categories are going to be are being proposed. So with next change, I will go into in statement of profit or loss, what other change is happening. Basically, one is with reference to foreign exchange differences and presentation of gains and losses on derivatives and hedging instrument. These are all practically, we do face these challenges. Where should I show foreign exchange differences? Currently, there is no laid down principle in IAS 1 or in other standards. So in this new proposed standard, there is a rule laid down. Basically, it says that you classify foreign exchange differences in the where the income and expenses of that item which gave rise to those differences is presented. For example, trade payables, the expenses which gave relating to that, they are presented as purchase of goods, which is normally operating category. So foreign exchange difference on trade payable will go into operating category. At the same time, if foreign exchange difference is in relation to borrowings, then the borrowings interest expense is normally classified, goes into a financing category. So you classify that exchange difference as part of financing category. So these are the rules, the new principles which are laid down. Then gains and losses on derivative and hedging instruments, very important. There could be derivatives and non-derivatives also used for hedging. So the principle laid down are, in case of those used for hedging and which are formally designated, then for derivatives and non-derivative, you show that gains and losses on that in the risk type of which the entity manages. If some derivatives is managed to hedge the risk of a interest rate risk, which is a financing, then it goes under that financing category. If it is relating to some other operational, related to operational category, operating category, then it will get classified under that. So similarly, for there could be derivatives somebody might be using, which for hedging purpose, but they are not designated using the IFRS 9 or in Indian scenario, Ind AS 109 hedge accounting norms. So for derivatives, what will you do? The principle now given is you use the same thing. If you are using that derivative for designated hedges, where will you classify in the same category you do it? And the similar rule, I think, for non-derivative also it applies. And if some of the derivatives and these non-derivative instruments, they are not used for hedging purposes, then where do you put them? In case of derivatives, it goes as part of an investing category. As you have seen in statement of profit or loss now, there will be operating, investing, and financing. There are three kind of categories. So these derivatives, you'll show them under that, unless these are used in the main business activities of the entity. It means certain banks and certain financial institutions, the derivatives, etc., are they're part of their main business activities. In those cases, it goes as part of their operating activity. So this is with reference to the profit and loss, fair value gains and losses of derivatives, where will you show it? And the next item is about the presentation of joint income from associates and joint ventures, which are the equity method of accounting is being followed. So there are different views which the people had. Some people said that yes, these associates and joint ventures are as good as my business, main business. So that's why they are my part of my operating profit. But some said that no, they are not my main link to main business. So they are more of an investing activity or financing. So I will not show them as operating. So there was a sort of a different views prevailing. So the proposed approach is balanced approach. It's called. It says that you classify these associates and joint venture into integral joint associates and joint ventures and non-integral joint ventures. And these will be shown. The integral, equity accounted associated and joint ventures, income relating to that, and if they are integral, they will be shown as a separate line item. You have seen it in the one of the slides which I showed you, that there is a after operating profit, there is one line item. So one need to show it there. And in case of non-integral associates and joint venture, these will go and get presented as part of investing category. So you all must be wondering now, is there a way or a criteria laid down? When should I classify integral and non-integral? Yes, but this criteria is not there in the proposed IFRS 6, which is will come into picture. But there is going to be a criteria added in IFRS 12, disclosure of interest in other entities. So one of the important criteria laid down is if there is a significant interdependency between an entity and an associate or a joint venture, then that will be classified as integral to the main business activities. And there are a couple of examples or the illustrations which are given. When do you treat it as an interdependency between an entity and an associate or a joint venture? Of course, one of the item is if you are sharing a name or a brand with an associate, it is likely to be treated as that associate or joint venture as part of your integral. Yes, I would now, this is another item where the panelist and yourself see that is that a good yardstick criteria to be applied to classify whether an associate or a joint venture is integral or non-integral. Of course, one might also say that in India we have AS11, where foreign operations we used to treat had certain criteria to consider into integral and non-integral. Can that be also considered? So that's about the associates and joint ventures. Now, next 3-4 slides, I'm going to go a bit quickly here. This is just to the illustration examples of the IASB. There are illustrative formats of the statement of profit or loss are given. If you apply these proposed principles of operating, investing, and financing, how does it look? For non-financial entities, see this slide number 15, it looks like this. So you have a start with a revenue, and then there are expenses relating to that operating category, then operating profit will come, and then there is an integral associates and joint ventures, share of profit or loss will come, and then you'll have a subtotal, which is operating profit plus integral associates income, and then non-integral next two subtotals are share of profit or loss of non-integral associates, and then dividend income, which is more of investing, then profit before financing and income tax, and the financing related activities, income expense presented, then it goes down to the net profit or loss. So this is for a manufacturing or a trading type of an entity. For financial entities, yes, the items which normally for manufacturing and others you treat them as investing or financing, that is interest income, fee and commission income, and all these kind of items will come as part of their operating profit. So there is for financial entities to meet the requirement, there is a their business nature of the business of that entity, a different format is also illustration is given to illustrate the principles which are actually given in the proposed standard. Now, for insurance activities, an entity with an significant insurance activities, its statement of profit or loss is likely to look like this. And you would be wondering, now what should I do if I have a mixed operations? Like in India, it's very common, NBFCs, which have mixed both financial activities as non-financial activities. So currently, we do have in our Companies Act, Division 2, Division 3 is there, which talks about the for NBFCs what should be the format of a profit and loss account. So similarly here also, the proposal there globally is that yes, it should reflect both their trading activities or manufacturing activities operations as part of operating, also the financing type or relating type of activities also as part of their operating profits. This is an entity which has both manufacturing and the financing activities. So now we can say that globally also there is a proposal that yes, there will be certain uniform principles and criteria laid down, but yes, considering the little bit of diverse set of entities, there will be more than one set of you can say formats of the financial statements, which I think in India, which we have been actually following since since long. Now I'll go into very quickly a small an item. This is the role of primary financial statements and notes, and this is basically, this area has been actually discussed, and the proposals are given because there is an important information about giving aggregating and disaggregating financial information. And here there are three areas which I would like to just highlight to you quickly. One is about the analysis of operating expenses by nature or function, and then unusual income and expenses. Very important item, which is currently there is in IAS 1. There is nothing exists other than disclosure relating to the material income and expenses. But now a new item which has come in, unusual income and expenses. And there are also prescriptions around, or some guidelines around, if you have to group items, whether it is the profit and loss count item or the balance sheet item in the notes, etc. What should be the criteria for that? So basically, one of the concern is that the dissimilar immediate items also need not be clubbed as just one single item as other label or a miscellaneous income or miscellaneous expense. So there is some kind of principle which is being prescribed under the proposed standard. Now I'm going to concentrate on two important areas here. One is about the analysis of operating expense by nature and function, and the unusual income expense. So analysis of operating expenses, currently the IAS 1 globally allows a free choice for entity. Either it can present either by nature or by function. You might know that in India we do have a restriction around that, and in IAS 1 we have given only presentation by nature, not by function. Now the prescription is that it's no longer going to be a free choice globally. Also, there will be a set of indicators entities have to follow, and then one of the main criteria is that information, the entities have to decide whether to using nature or by function operating expenses, which is going to be most useful information to the users of financial statement. So you have to look at it from the lens of the users of financial statements. And then you need, the company should not mix the two methods. Like you can't say that for my operating category in profit and loss count I use the nature, and for my financing related category I'll use of the function. That's not permitted. And what is the if somebody is using the disclosure of analysis of presenting the operating expenses by function, the requirement is that disclose the analysis by nature in the notes to accounts. That is the prescription which is there. So this is an important area for us actually debate and discuss. Yes, if we have sound views, and if you have a very logical this one, that yes, even this kind of option may not be suitable, of course we can actually form communicate such kind of views. Now I go to the next item, which is very, very important for all of you, the unusual income or expenses. Currently, you know that there are items like extraordinary items, which is there in our accounting standards, but not there in Ind AS. And then in Ind AS, or even in globally also IFRS, this one you would see that some entities used to call and present some items as exceptional item. But there was, what was the ground rule for that, to call an exceptional item? So, but this is the information which is useful to the users also. That is why the proposal is that there is going to be a definition of what is unusual income expense, which is basically these are income expenses with a limited predictive value. It means when you're deciding does it have a limited predictive value or not, whether is there a reasonable expectation that this income expense will not arise for several future annual reporting periods. So important consideration when you're looking at a limited predictive value is basically it is while you look at both by unusual by the type of the item, there's a nature, also the amount also, but look at from a future point of view. Is it likely to occur in future? Not necessarily the past occurrences. But yes, it's a very challenging aspect. One need to decide, because whenever you think about the future, historical information and historical experience is always used as a ground rule or a very good benchmark. So, but the standard proposed standard says that you only look at it from the future perspective. And if there is unusual income expenses, what will you do? You give a single note, disclose it in a single note, amount, narrative description, and line item in which the same has been included, and analysis by nature. Why this is given a single note? Because there were some entities which were actually presenting this in the main statement of profit or loss itself. A separate column was given as a exceptional item. So, and there are different practices. That's the reason it has been actually now made the proposal that this will be given only as part of a notes to account. This is one example, the illustration example which is given in the IASB's along with the IASB exposure draft, that if there is an unusual item by type, how will you show it? What the disclosure requirements are there. On the left hand side, you show the line item in the profit or loss where it is included, and on the right hand side, what is the type of that item that need to be disclosed. Now I am coming to the another important area, which is about the management performance measures or non-GAAP measures. And what I'm going to do is also in the due to sort of a time constraint or so, slightly move fast on some of these slides, so that in the during the panel discussion time, etc., we'll have a very good discussion around these areas. Management performance measures, which are also called non-GAAP measures or alternative performance measures. Some of them are like adjusted profit or adjusted operating profit, adjusted EBITDA, etc. These are presented. These are having relation with the items presented in the statement of profit or loss account also. So if you see this based on this, the research and analysis done at IASB level, there are quite a lot of many percentage of companies which are presenting this information. And was there a reconciliation provided to a nearest item in IFRS standard? Yes, 70%. Good thing is 70% provided, but there was a limited information which was given. Now, as you know, these management performance measure items, which are actually can be classified into non-performance measures like number of subscribers, customer satisfaction score, etc. And then could be financial performance measures as well. Within financial performance measure also, there could be two categories which can be linked to the items reported in our statement of profit or loss or balance sheet, and some which are not they are not directly linked. For example, a free cash flow, return on equity. Some of these kind of items which are financial performance measures, but they cannot be directly linked to the the statement of profit and loss account. So this is the way the performance measures are there, and the investors and users, the current this one is that they do actually appreciate and they like this information. Only thing their request is that there has to be some discipline around that, and it has to be done in a transparent way. So to achieve this purpose, what currently the IASB is proposing is that there is going to be some definition of management performance measures. What do they mean? These are subtotals of income and expenses that are used in public communication outside financial statements. And these are actually meant for complementing totals or subtotals specified by IFRS standards. And these are intended to communicate the management's view of the entity's financial performance. So this is the definition of what the MPM means as per the proposed standard. And in next slide, you will see that you may have been expecting that it covers everything what is presented currently as non-GAAP measures, but it does not. And what are the requirements in the standard? One important requirement also says that there has to be a reconciliation between management performance measure presented and most directly comparable subtotals specified by IFRS standards. There is an example subsequent slides I'll show you. You'll come to know what is the reconciliation means. And there has to be description of why the management communicates this MPM and how is it calculated, and how does it provides a useful information about entity financial performance. And then another important area is also linked is when you're giving this reconciliation, give what is the income tax effect of that and effect on non-controlling interest also. So these are the disclosures requirements which are laid down as far as the management performance measure is concerned. One is there is some definition of what management performance measure means and how this is going to be disclosed in the notes to account. This is an example which I was quoting. Says operating profit is one of the line item which is specified in the operating in the proposed IFRS standard. There could be others also, but in this example, one is given is you can with reference to this. And how did you adjust this? Adjusted this operating profit? Restructuring costs are removed, and then there is some revenue related adjustment. What is the total amount, and then what is the impact of that tax impact on that, and what is the impact relating to non-controlling interest. So this is an example of a disclosure of reconciliation of management performance measure and the primary financial statement subtotal. Now, as I said, not everything what we expect or we thought of all non-GAAP performance measures are going to be within the ambit of this standard. It's not so. One of the first important thing you will see is that there was a proposal to define what is EBITDA or EBIT, that earning before interest, tax, depreciation, amortization, which is very commonly used. But the IASB has, as of now in the proposed standard, it has not been considered, and there is not going to be a definition of this. And this item probably whether will it be part of if something is presented on those lines, is it MPM or not, we need to see. Second one is it also talks about certain important areas like financial ratios, measures of growth, measures of liquidity or cash flows, and then financial performance measures. These are all not going to be within the ambit of MPM. It means, yes, there is some solutions to the problem of alternative performance measures and the measure. But yes, one might say that yes, still there is a large population of items. Can it be covered within the ambit of this MPM or not? Yes, I leave it to the judgment of the panelists and others to discuss this aspect as well. Now that was all about the primary financial statements and notes to accounts, which are subject of IAS 1. Now, in other standards, quickly I'm going to cover what are the other changes which are made in the other standards. The first one is statement of cash flows. As we know, interest paid, interest received, dividend, there were choices available, classification choices available, either operating financing or operating investing like this. So now, in the proposed approach, there is going to be no choice for entities other than whose main business activity is financing activities. So interest paid, it has to be part of financing. It cannot no longer be operating or financing. Similarly, the dividend received, it cannot be either operating or investing, but it has to be investing. Yes, there is some concession given for the entities whose business is either investing or financing, but in other cases, this choice is now going to be proposed to be curtailed. Earnings per share is another standard where there is going to be some change. What is proposed is currently, apart from basic and diluted earnings per share, if there is any adjusted EPS, it could be presented with reference to any of the subline items. You can include discontinued operation in that, or you could do it before this discontinued operation, or before tax, after tax, all those that option was available. But now there is a restriction around that, and it says that if you are presenting a adjusted EPS other than basic and diluted ones, then it can be presented. The numerator for calculating that should be only a performance measure that is attributable to holders of equity claims of the parent. And this additional disclosure also, one other important criteria is it has to be only in the notes and not in the face of the statement of profit and loss account, or in the primary financial statement. And a very important the proposal, and you can say a good discipline around where it need to be disclosed. And in this slide, I'm quickly just summarizing in other 4 standards what are the changes that are happening. IAS 8, some portion of the existing IAS 1 is going there. And interim financial reporting, it is a consequential change because of inclusion of unusual income expenses and management performance measures. So there is a change, a couple of paragraphs in the interim financial reporting. And then IFRS 7 financial instrument, again, it is relocation of the prescriptions, a disclosure relating to portable financial instruments from IAS 1 to this standard. Then IFRS 12, disclosure of interest in other entities, an important change. The criteria for classification of associates and joint ventures into integral and non-integral is included in this standard. So whatever the new proposed IFRS, when it talks about that, how do you classify integral and non-integral, it will say that you refer it to that standard. So these are the changes that are happening in the other standards. And now what next from the stakeholders' point of view? Yes, globally, 30th September 2020 is the last date for public comments. But in India, we need to be ready with that much before that. So we need a lot of your engagement, active participation in giving your comments and your views on that. And with that, another important thing is there is going to be a field testing, a dry run, which need to be done. So we request, we are requesting many of the entities or Indian companies also to undertake this exercise. And if we do it as early as 31st August 2020, it will be much better, so that by 30th September, based on that experience of that field testing also, we can formulate our views, and we can give our comments to IASB. So with this, I'm just summarized what are the changes that are happening in the proposed approach. Of course, yes, our comments, your comments, all valuable, and we'll have to see how this subsequently takes in. With this, I'd like to now end this my technical initial briefing and hand over to Yagnesh Desai ji for actually taking it forward.
Thank you, Vidyadhar ji. It was a wonderful, very detailed and enriching presentation. Good deliberation in a very short time, in a very staccato manner. Wonderful, wonderful. After hearing you, it appears that had this standard been effective, COVID-19 would have been unusual income or expenses. It appears also that when we are going to read the profit and loss account or the statement of profit or loss for that matter, we would be wondering, am I reading the cash flow statement or am I reading the statement of profit and loss? Friends, I have a breaking news for us. Here is a breaking news for us. And this breaking news is coming from none other than Dr. Sanjeev Singhal. While Vidyadharji, you were deliberating and discussing and all this, I got a message from none other than Dr. Sanjeev Singhal, and he said, Yagnesh Bhai, there are two good anecdotes to be shared with our participants and all of us, and which will smitten us. And that is, on two occasions, International Accounting Standard Board had followed Accounting Standard Board suit. One, we have not accepted the corridor approach, which was there at one point in time in the IASB, in the IS 19, which we have not adopted, which later on IASB had adopted. Then there is something bit technical about the fair liability measured at fair value through profit and loss account. In that case also, we had considered this as an item of other comprehensive income, which taking cue from ASB, ICAI, even IASB has taken as a part of the accounting OCI. So, friends, we'll have now the panel discussions. But hold on. The panel discussions will take place after the break. And there's a saying, as the saying goes, for the best thing, one has to still wait, and the best thing comes to those who can wait. So we'll come after 10 minutes break. After 10 minutes break, so please stay tuned in. Don't go away, because after break, you'll hear from the dignitaries and all the stalwarts of the domain field about the nitty-gritty of this accounting standards in great details once again. So don't miss out. Something very exciting is coming in your way. मिलते हैं ब्रेक के बाद 10 minutes after we'll meet. Back, friends, after the break. And for those of you who just join us, welcome to them. And now this part will have two very important panel discussions. Panel discussion one for the panel one will discuss the better communication, structure, and layout. Moderator of panel one is CA Pramod Jain, and the panelists are CA Dr. Sanjeev Kumar Singhal, Dr. Rakesh Agrawal, CAR Surakya Saab, I think this is not there. And secondly, the last is the CA Saraddin Datta. So there's a lot of disturbance.
We would request all the panelists who are not speaking to kindly keep themselves on mute.
Yagneshji, the panelists present are Dr. C. A. Sanjeev Kumar Singhal, who is the Vice Chairman of IASB, and Dr. Rakesh Agarwal, who is the Vice President of the Reliance Industries, and CAR Shankaraya, Group Financial Advisor of the Jubilant Bhartiya Group. And as Sradindu Dattaji could not join due to the network issues, so you have been added as a panelist out there.
But
the Yagnesh Desai, member of IASB.
Pramod,
and also we have our technical directorate, Vidyadhar Kulkarni ji out there.
Pramodji, can I briefly introduce all the panelists and including the moderator, please?
Sure, sir.
Sure. So now we have the moderator, CA Pramod Jain Sahab. Pramod Jain ji is a Central Council member, present sitting council manager. He's a chairman of the Valuation Standard Board and CSR Committee of ICR. He's also the convener of the IASB study group of IASB as exposure draft of the primary financial statements. Okay, you're the convener of the very SAPEN. That's great. And he's members in more than 25 committees, groups, and directorates of ICAI. He's delivered more than 1,000 lectures and articles on various topics like income tax, corporate tax, LLPs, audits, peer review, and quality review. We are great. It's our pleasure and a privilege to have personalities like you. And now we have Dr. CA Sanjeev Kumar Singhal ji, wo hamare mitra bhi hai, and he is Vice Chairman Accounting Standard Board and a Central Council member of ICAI. He is a FCA with about more than 2 decades of wide experience in the industry and audit and assurance in practice. Addressed more than 450 seminars on technical aspects of accounting, Companies Act, IFRS, Indies, etc., and has published many books. That's great. And then we have CA Rakesh Agrawal Sahab. If I may say so, and if with your permission, he is instrumental in making me the IFRS faculty back in 2009. गया था participants बनके and बनके आया था एक faculty बनके. I am grateful to CA Rakesh Agrawal ji for this gesture. Great support. He is presently the Vice President, Reliance Industries. Rakesh is a Chief Risk Officer and accounting expert in all entities within the RIL Group, leading various engagements involving the multi-GAAP reporting, Indian GAAP, IFRS, and EU GAAP. He is masters of 3 GAPs. That's great. He has not left any gap in studies. Accomplished items, training for the senior and the middle management also. And then we have CA Shankaraya. He is a group financial advisor for the Jubilant Bhartiya Group. He serves as the director on the board of several companies, has experience of more than 35 years, conferred with several prestigious awards. Mr. Shankaraya is a prominent speaker at various conferences. And I believe Sir Datta Sahab is not there. Am I right, Pramodji sir?
Datta Sahab is not, could not be, he could not join. He could not join.
So I am throwing open the forum to you, moderator sir. It's now up to you.
No, before that, I would also like to introduce our esteemed panelist and master of ceremony, Yagnesh Desai. Yagnesh Bhai is a member of Accounting Standard Board and has also been a member of India's Implementation Committee, a student of the IFRS course, whom we converted into a faculty, and we are really proud of him. His contribution to ICAI and to the profession is immense. Thank you.
No, Sanjeev Bhai, you just missed it. One more thing, he always, the way he orates is exemplary. I was just spellbound when he was as a master of ceremony, he was
Amin Sayani. He's acting as
Amin Sayani of Binakasi Sibakasi Gitmala. So you remind us of that, sir. So
good old days.
Going straight forward to this panel discussion regarding this better communication, the structure and layouts of the statement of profit or loss, which has been an outreach program by the IASB conducted by IASB in India right now. In the context of, I would say, the operating profits in the statement of profit loss, as discussed by CA Vidyadhar Kulkarni ji in the introductory program, that it proposes 3 mandatory subtotals in the statement of profit loss. One of them is our operating profit. So the question is, do we actually require such subtotals based on such concepts, or EBITDA, EBIT, it could be better? My question, this is to CA Rakesh Agarwal ji.
Yes, Mr. Vidyadhar Kulkarni just explained in his slide 8 the 3 bifurcation with respect to the profits element. And there cannot be a perfect time to introduce this thing, especially in India Inc. as a whole. See, accounting is just enabling comparison as well as additionally predictive value with respect to India Inc. as a whole. So let me throw out the statistics of India Inc. as a whole on the key numbers, and then we'll link it back to the 3 subtotals that we are required. First, as we speak today, the market cap of all companies put together is roughly, say, 140 lakh crore. Now, if I look at typical book value, price to book value multiple, it is 3. So roughly the book value of all the entities put together, net worth, is say 50 lakh crores. And when we say P multiple is 20x, in other words, 5 lakh crore is the profit. Hold on, 5 lakh is the bottom line that we are talking about for companies as a whole. But when I look at the leverage, India Inc. is a net borrower. And when we look at the net borrower, say if we put a dummy ratio of say 1:1, then practically on a borrowing of 50 lakh crore, I'm ending up paying interest of say 4 lakh crore. So if I have a profit of 5 lakh crores, India Inc. as a whole, after paying interest payment of 4 lakh crore, then perhaps these 2 numbers are quite material. Now, when we are talking about operating profit, the way companies look at business, although traditionally auditors are looking at or accountants are looking at post-mortem, but the financial statements, these are also one of the objectives of this exposure draft XX. So when I look at predictive value, the question is, what is a normal operating profit excluding the unusual items? So when I look at the standard, the 3 totals that they are addressing are A, the final profit, that is good enough. B, profits relating to the weeding out the financing element. And in our case, for India Inc. as a whole, it is around 80% of the profits of entire India, which is on debt. So that subtotal, there are few companies which are debt-free. There are few companies which are highly leveraged. To just give a right valuation to the business models and with an easy comparison, and whatever we do, it goes as a taxonomy for aggregation of national data for a more meaningful comparison, this subtotal becomes important. And above all, when we are looking at the predictive value, the first subtotal out of the 3 which we spoke is the operating profit gains more prominence. So this, in my view, is perhaps the right time to emerge, if not catch up, with the developments that are happening in India Inc. as a whole, and the standard setters have rightly responded.
Shankariya ji, do you concur with the views of Rakesh ji, or do you have a different view that it could be based on EBITDA or EBIT, or it could be taken to the notes and the statement of profit loss could remain same? What are your views on this? Unmute कीजिए एक बार. Unmute कीजिए.
So good afternoon, everyone, and Pramod ji, good afternoon. So it's a very good question. Let me start saying that my long-term objective, maybe Dr. Sanjeev Singhal can confirm that, because we both were working together for more than 5 years. We were struggling to disclose to the market how exactly the operating performance of the company to be disclosed. Like Rakesh ji has mentioned, borrowing cost should not purely determine the valuation of the company. So you have to clearly understand what is the, if you see the topic, what we are talking about is best communication of financial reporting. If that is the topic, then what is the objective of financial reporting? What is the objective of drawing up the financial statement? It is basically to take a transparent or conscious decision by the investors or by the lenders or public at large. It should be helpful. As Rakesh ji has rightly mentioned, this is the right time to introduce this concept of operating, non-operating, joint venture, integral, non-integral. All those things are perfectly fine. But the only my point is, by defining operating profit as of today, are we achieving really what we want? And also by segregating joint ventures and the integral part, non-integral part, putting separately, are we really achieving what we want? My point is, the business is valued. If any balance sheet or P&L is given, or a balance sheet or a financial statement is given to any investor or anybody, even the team of professionals who have joined today. So the first thing what they see is, what is the revenue? What is the PAT? AS1 or IAS1 clearly, Ind AS 1 or IAS 1 clearly talks about that. No problem, these two line items. Whereas all other items are given discretionary to the people to report the way in which they want. Defining this is very good, but is it the right way of defining? When it comes to that question, maybe globally what is understood is EBITDA, that is earnings before interest, tax, amortization, depreciation and amortization, or EBIT, maybe after providing depreciation, or EPS derived from the PAT. But that is not helping alone unless you identify what is out of EBITDA, exceptional, non-exceptional. So ultimately a business is valued, or investor understanding or the lender's understanding will be defined based on actual performance or measurement of the company. For that, globally, it is number of times of EBITDA multiple minus the debt is the enterprise value is arrived at number of times of EBITDA multiple minus the debt, you get the equity value divided by number of shares, that is the share price. That is how it is arrived. So what is important to me, in addition to this, something what is known as EBITDA, EBIT, that measurements has to come in somewhere in the income statement to give a clarity for the investors or for the public at large to understand the financial statement. That is my view.
You are saying that apart from this operating, this should be fine. Apart from this, EBITDA, etc., should also be disclosed separately. So this is the view.
Given a choice, I will go with EBITDA. But there may be a reason for mentioning the operating profit, but that operating profit doesn't have any meaning as of today, because it's not widely understood public at large. So EBITDA may be a better measurement as of today to monitor the performance or to understand the performance of the company.
Or it could be into various context of our Indian concepts that we say. In the Indian context, EBITDA is more understood as compared to operating profits, I would say.
Sir, it is not only Indian context. Let me tell you, because we have companies across the world. I have done US GAAP, IFRS, 7 gaps I have followed. So everywhere the best measurement of the operating performance is EBITDA. That is very clear.
Great. So now the classification of the income and expenses into the 4 specified categories of operating, investing, associate, joint venture, and financing. So what is the rationale before this approach? Do you see any merit? I'll ask this question to CS Sanjeev Singhal.
Yeah. Thank you very much, Pramod Bhai. In fact, when Mr. Shankaraya was mentioning 7 gap, it reminded me of my jubilant days. I used to take care of those 7 accounting gaps. So Pramod Bhai, question is actually very important. This classification into operating, investing, and the financing activity, associate and JV. Mr. Shankara was also saying that what's the rationale? So I think one rationale could be like in our cash flow statement, we have operating profit. I mean, we have cash flows from operating activity, investing activity, and financing activity. So the idea may be to match it from cash flow statement, but actually speaking, it will not match because the items contained in a cash flow statement are entirely different. Correct. And I agree with this suggestion that actually EBITDA is a better term, and that is more widely understood. Rather, operating profit may be misunderstood. I mean, although operating profit is also a term which is being used, but when we are talking of operating cash flows, then the users of financial statement may actually try to match the operating profit with operating cash flows. So to my mind also, EBITDA and EBIT, or even if we say profit before interest and tax and profit before tax, they are widely accepted terms. So instead of operating, if we can have the EBITDA, that may be better. So I think I would say that the rationale could be its linkage to cash flow statement. However, I would say EBITDA and EBIT are better terms.
So what Sanjeev Bhai is saying, that we already have cash flows where it is given regarding my operating flows and my financing and investing. So one flow is already there. So we are having that in operating in my statement of profit loss could create certain comparison, all those things. What is your view, Yagnesh Bhai, on this?
I do concur with Sanjeev ji that EBITDA is most commonly used, most commonly understood phrase rather than operating profits and all this. And in fact, there is a criteria in many cases for the funding by the non-banking finance comes in all this. And once it is in the same style and pattern, it is being prepared as per the cash flow statement. It will give more a better ground for the comparability of this income statement and the cash flow statement. So it does make a sense of dividing into these four parts. One more thing, sir, I need to mention here that when it comes to the income from finance cost or the finance income, sometimes it includes the income as a result of the unwinding of discounting also, which is in fact not a financial income. For example, unwinding of the defined benefit obligation is giving rise to the finance income also, finance cost, which is actually not the finance cost. So it's very sensible that this kind of category is being made.
Sanjeev Bhai, we have already talked that cash flow as per IAS 7 gives all these things. So, but the discretion is still maintained for my interest received and paid. So, do you think that it would be better to uniform if it is a uniform prescription is given in the lines of Ind AS here?
Absolutely right, Pramod Bhai. In fact, I mentioned this in my opening remarks also, and which Yagnesh Bhai mentioned. Yeah. So, see, there are four terminology that we use: interest received, interest paid, dividend received, dividend paid. Interest received is treated as investing activity. Interest paid is financing. Dividend received is investing, and dividend paid is financing. This is in Ind AS. In IAS 7, this flexibility of classifying them operating, investing, or financing activity exists. Now there is a proposal for dividend, at least, that the dividend paid should be a financing activity. I think this will be better. This is aligned to Ind AS. And this options are being curtailed, as we call it, as a curtailment of options, so that a consistency in the understanding of the cash flow statement of various entities is ensured. Of course, the entities which are, whose main business is financing, for them, this will be operating. But otherwise, I think it will be useful the way it's been done in Ind AS. If IAS 7 can be aligned to that, that may get the results.
Shankaraya ji, do you concur with the views of Sanjeev Bhai or some different?
Yes. No. It makes all the sense to exactly divide. Again, I don't want to repeat the same thing. Absolutely, that is the way it has to be done. And not giving an option is a better thing, so that there is a uniformity in drafting the financial statement rather than a confusion.
Rakesh ji, coming back to this, our operating income, when we talk about this operating category, would it be just like a residual category? Is there potential for this to become an omnibus type of category?
The way, if you look at the surface of the classification, prima facie, it gives a feel that anything which is not in the relation of financial expenses and anything not relating to JVs and associate, it do as a starting point give a feel that this is a residual category. However, it is not. Primarily for two reasons. And I'll not say devil lines in details. I'll say these are basics which has been run through the standards, the entire exposure draft. So when I look at the exposure draft, it gives you two principles. A, anything which is unusual needs to be weeded out in a single note, and that has to be explained. And the second part is the concept of disaggregation of information. So if I apply the yardstick of disaggregation of information, for example, anything which is others, it is not, cannot be shown as others. You just disaggregate. Anything which is unusual, you just pull it out in a separate note. So when I look at as a starting point, that tinkering look like, oh, yes, it is a residual category. But when I read it with the applied provisions of the core standards, it is not a residual category.
Yagnesh bhai, do you concur with the views of Rakesh bhai, or some have different views on the same?
No, I do agree with Rakesh. I do agree with
Rakesh ji, again, another question related to my classification of my associates and JV. Now, it is now to be done as integral and non-integral category. And AS11, if we talk about the distinguishment of the foreign operations of the foreign exchange difference accounting. So, is there a similar approach or a different for the integral and the non-integral thing? The same AS11 approach or different?
Yeah, I'll put it, when you look at AS11 approach, it was more towards identifying a foreign currency transaction, to what extent I need to take into PNL and to what extent I need to take it to reserves. And the entire focus as well as the meaning of integral operation was from different levels. When I look at this revised standard, this standard, the way it looks like, it gives a complete benefit of a corporate. India Inc., if I look at, it is broadly an emerging market. And in emerging market, it's a principle of conglomerates and large business houses and smaller business houses doing multiple business. When we transition to a mature market, you have only sector-specific large companies and not a conglomerate or business houses which are promoter-driven and otherwise. And in the journey, when India is transitioning from net debt to only pure equity-based company, there is an element of monetization. And when I look at the element of monetization across India Inc., there is one thing that is primarily important in terms of classification. A, which businesses are largely earning independent cash flows altogether from all other businesses and they are not dependent on this? And which other businesses or clusters of various entities that needs to be grouped together? It is precisely this requirement that is specifically addressed in the revised exposure draft. And we welcome it, at least I welcome it from an Indian perspective.
One question out here, to my knowledge, to my understanding, for my understanding, whether it would be for a standalone or for a CFS, consolidated one. You know, when it is a standalone, then
yeah, I'll answer. In fact, the entire Ind AS or say IFRS is written only from the perspective of consolidated financial statements. So I'll presume it is always consolidated financial statements.
Yes. So when it would be there, because when we are preparing for the standalones, then this integral and non-integral approach will not be applicable. What I feel, Yagnesh bhai, what is your view? Or
I think Conso is prepared on the same basis as the standalone financial statement. So I don't think you have a different criteria while preparing the Conso from the basis of the standalone financial statements. The only thing is that we need to see whether the equity method to be applied to the non-integral part or not. Rakesh, is it the same thing?
When it would be, it would be when it would be standalone, then there would be a requirement for classification into this integral and non-integral, just for my knowledge.
There is a possibility, but unlikely. In most of the standalone financial statements, generally the stand that has been taken and applied is you account it at continuing cost. Typically, people don't want volatility unnecessarily in P&Ls. So enterprises have more often used the option of accounting it on the basis of historical cost or deemed cost. So the additional lift up of numbers may not be needed.
Right. Sanjeev bhai, one positive angle to this disclosure is that it gives an opportunity to entities to communicate and explain why or how these financial performance have been affected by unexpected or unusual events like COVID or maybe any other natural calamity which could be there. So, do you agree with the way that it is defined that the concurrence of such event in the future is the determining factor and not the past concurrences? Is it going to be different from the way exceptional items of the present practice are understood? Or do you think that the exception item is better as compared to the?
See, Pramod bhai, this is a very important question. An exceptional item, an extraordinary item, these are the two terms which we use in accounting standard. But when we come to IFRS, it's only the exceptional item which is covered. In fact, you are also subject matter expert in accounting. So I must mention that. The term unusual item, actually, see, I believe in business, exceptional is a better word than unusual. And secondly, it's correlation to future, right? Right now, COVID-19 has happened. Are we expecting this to happen again? We would never want to happen again. We would never want given a choice. So there is no question of expecting it to happen in future. Has it happened in the past? Not necessarily. I mean, maybe a Spanish flu, which we are talking about, happened 100 years ago. So future is not known. I believe that if we are saying that whether it is likely to happen in future or not, that yardstick should not be applied. No one knows the future. An accountant certify and audit the historical financial statement. So I believe that correlation with future is not really, may not be a good practice. And secondly, exceptional is a term which is understood by so many people. Even this COVID-19 expenses, ICAI, the Accounting Standard Board of which you're a part, has issued this guidance that when can you classify the COVID-19 related expenses as exceptional items. So I think if a definition of exceptional item is given, which at ICAI we have explained through our educational material in Ind AS 1. So I think if a guidance on exceptional item is given, the definition is given, that may be better rather than classifying it as unusual item.
Shankarji, do you concur with the views that exceptional item is much better as compared to the unusual?
See, in business, there is nothing called unusual.
Unusual.
Because anything can happen. And when you run a business, you are determining the business events based on the current circumstances and identify whether on that particular year closing, whether that particular item is an exceptional or it is usual, or it is normal business expenditure. Normal business expenditure. So this is one thing which, in fact, last so many years I was fighting with the auditors always. Then finally, SEBI at least has brought in one line item to disclose the exceptional item separately in the disclosure. That made my life so comfortable to disclose to the investors. Okay, this is a exceptional item. So considering this exceptional item, the normalized EBITDA or adjusted EBITDA of the operations of the company is this. So first of all, exceptional item, there is nothing called unusual in the business. It has to be called as exceptional. Second, this exceptional, you cannot, like Sanjeev ji has mentioned, future what happens, Bhagavan ka malum hai. So nobody knows. You can't be saying in future it may happen or not. See, once you know that it may happen or not, then you will find that it is a usual expenditure and you know how to address that. Then it becomes a usual business expenses. So it has to be exceptional. Second, it should not be determined based on future. It has to be based on the current circumstances on which the profit and loss account or the balance sheet or the financial statement has been drawn up. That is the way it has to be identified. And of course, there is already enough guidance about how to identify exceptional item, etc., etc. That can be beefed up by giving a clear guidance on this. This is how it has to be accounted.
Now, very rightly said, Shankaraji. And now this is in relation to the classification of the fair value gains and the losses on derivatives and the exchange differences. Rakesh ji, this question is for you. That the proposal actually permits even derivatives which are not formally designated as hedges, but used for hedging purposes to be presented in the same way as those used in the hedging accounting. So what is your view on this?
See, over time, matters have matured enough to bring substance over form into accountancy, irrespective of the technical aspects. Now, if I look at the precedents, we have brought substance over form by initially introducing, say, consolidated financial statements rather than just standalone financial statements. We brought it by introduction of standard on, say, finance leasing, which otherwise always treated as operating lease. We introduced the concept of deferred taxes, which was altogether new. Now, although traditionally we have been born and brought up with a view that hedges are designated at inception, hedges are designated as inception, hedges are designated at inception, this has been brought into our mind repeatedly. But if I had to look at, it doesn't make a difference if an organization has hedged in real sense. And hedges is also, when you have multiple businesses, you can hedge within your own intragroup transactions as well. In the course of journey, rather than going outside at the inception of the contract, based on your regular governance mechanism, there is an organization agility and response with respect to emerging circumstances. So even if something has been done midway, directly or indirectly, and if we wait to bring back into accountancy the real intention, then I will not make a very big difference between whether it was designated at the beginning, unless it is the simple question, hedge versus non-hedge. So I will agree with the provisions of the new standards that yes, it can be disclosed together, as long as this is hedge.
So, Pramod bhai, you're on mute. Kindly unmute yourself.
Sorry, I keep on muting myself so that the voice is clear to the viewers. Yagnesh ji, any of your comments on this issue?
Sir, I would say I would bring attention to BC 99. It says very clearly that this presentation and disclosure does not really vitiate the recognition and the measurement requirement for the derivatives, including the hedge accounting requirement. And they say that including the hedge accounting requirement as required by IFRS 9 will remain unchanged. So this is not going to vitiate the accounting of hedging and derivatives per se. It is only for the presentation that you are splitting up and aggregating and disaggregating. BC 99 is a very good paragraph concerning this.
Good. Sanjeev bhai, we all are very much clear on this, that in India, the financial statements format, the presentation is as per the regulations Schedule 3. So when this proposed amendment is made applicable by IASB, so do you agree that, do you understand, or you perceive that whether the regulators in India would be aligning and taking it and amending those laws, would it be easy or what?
Yeah. So, Pramod bhai, I tell you that the MCA has been very supportive of the changes, whether it is NFRA, because once the council approves, then it will go to NFRA, and then finally it goes to the MCA. So whatever changes have been proposed by the institute, because everyone acknowledged that ICAI is the domain expert, right? So whatever changes are proposed by ICAI, these are discussed in the NFRA, that 15-member panel which is there. So I'm sure that once this amendment is brought into by IASB, then Accounting Standard Board will also deliberate it, issue an exposure draft, take it to the council. And once council approves, then we'll take it to NFRA, and I don't see much of a challenge that that amendment in Schedule 3 should not be a challenge. And even otherwise, The Schedule 3 also says that the accounting standard requirement are over and above the Schedule 3 requirement. So it is possible to add a line item or a sub-line item, even if it is not specifically mentioned in Schedule 3. But I'm sure that Schedule 3 will be amended. But even if it is not amended, it will be possible to add a line item.
But Sanjeev bhai, it would be not through NAFRA, because NAFRA is only for accounting standards and standards on auditing. But Schedule 3 would be under the company law. So MCA would be taking it directly through Schedule 3. So
very good question. So then apart from IASB, it is the corporate law committee. So our Chandrasekhar also will be taking it to MCA. But your point is well taken.
Now, going to the last question on this panel, so I'll request the views of each and every panelist one by one. This is upon the uniformity of the structure of the statement of profit loss, which is the proposed one, that the subtotals and the categories in the profit loss are bringing in one size fit all approach. Is this approach desirable? What will be the benefits, pitfalls from a CFO, investors' perspective, and various other stakeholders' perspective, including, I would say, the tax department and the MC and the bankers and all. So one by one, I'll request first Shankaraya ji to please give his comments.
Yeah. See, from the preparer side, if you want to divide this into three line items, if you wanted to introduce, it is very much welcome. But please clearly define what do you mean by operating profit. By just mentioning this is operating profit, it is not going to satisfy the whole world. So it has to be clearly mentioned. My difficulty there is, like Sanjeev ji also mentioned, see, when you say operating profit of the company, below that you say integral, non-integral part, or integral part of the JV's operating profit, then integral part of the JV's expenditure and income, then adding together again show one more line, including the JVs. So that's after you're doing the equity method. So that will little bit creating a confusion there. That means to determine what is operating profit, by going through the exposure draft as of today, I am not getting a clarity. Yes, operating profit means this is the one. So one fit for all. Whether we will achieve this with the existing exposure draft, it is doubtful unless you clearly define what is operating profit. That is the main point which we have to see. And second point is, when you wanted to bring in, suppose if you wanted to bring in EBITDA instead of operating profit, which is globally understood, no problem at all. Suppose if you don't bring in by any reason, then if you stay with operating profit, then somewhere it has to be given the EBITDA, it has to be defined. Then the problem which will come is that if you see International Accounting Standard versus US GAAP, there is a capital market, that is SEC, which will determine certain things where they will define non-GAAP measurements, which clearly defining, okay, these are all the non-GAAP measurements which will be published, and most of the investors or most of the public use non-GAAP measurements, because finally if you see US GAAP based or even IFRS also tending to that becomes a statement which is very difficult for anybody to understand. So go through the non-GAAP measurement and make a valuation of the company or evaluate the company what to do with that. So when you bring in that non-GAAP measurements, there how we are going to deal with, whether we are going to leave it to SEBI or we are going to take it with the standard setter and do the things. That clarity has to be there in India. That is also equally important to determine these definitions. And when you do this also, like Vidyadarji mentioned that very clearly, EBITDA can be given in the notes to accounts, etc., with the reconciliation. Then who is going to audit that reconciliation? Who is going to validate that reconciliation? Is the responsibility of the auditor, or it is the management responsibility to take care of that? because when you prepare the prospectus for an IPO or for equity raising or anything, so you need to go to the operating profits definition. That is where it is. So you need a clear understanding and reconciliation between these two, or clear definition, so that everybody understands this properly, so that there is no confusion in that.
Very well said, Shankar. Now I'll request Yagnesh ji.
Pramod ji, since मैं double भूमिका निभा रहा हूँ, panelist and the MOC का, so I just would like to humbly remind you that just we are giving little overboard. So can we have 3 minutes more only, please?
Sure, sir. So your comments first, sir. Then.
Yeah, but one fit for all is an utopia is very difficult to achieve. So I don't think it is going to address the question requirements of all in one, and it cannot be panacea for everyone. That is not possible.
Rakesh Agrawal ji, your concluding views on this subtotals and the categories is very important. So, what are your overall views on this?
I'll say that let me put it the broader global macro first, and what we need to do much more, and to what extent this is a step in the right direction. So if I look at most of the 80% of the value that has been generated across the world is by FANGs companies, be it Facebook, Apple, and so on. We live in a world where intangibles which the world values are not brought to books in accounting. And we also live in a world like India Inc., especially the hard stress sector, where the assets which are brought in books does not exist. Now, the question is, for a period of time, the standard set mature with the emerging realities. Now, the biggest step in the right direction is bringing predictive value into the financial statements, and that predictive value, we have already taken a conscious decision that we are not going to go for rule-based standards, we are going to go for principle-based standards. And when we go to principle-based standards, we cannot have each and every subsegment or various companies or various parameters or long listing. By definition, it applies to material items. So when I look at the key totals which are bifurcated, for example, layering of companies in India is a common thing. So a typical business house may have 10 or 200 companies within the group. And if we bring those layering of the companies into the right context, that's the one total, which has been a step forward in the right direction. Segregating earnings versus finance, which is an equal amount by and large, is a step at macro level in the right direction. And putting the predictive value of the information with certain caveats, which are principle based within the standards, is a step in the right direction. Whether all this will put together meet the needs of the emerging global megatrends, the answer is no. But whether it's a step in the right direction compared to the standards that we had in the past, I'll say it's a significant leap. So I'll say it's a big step in the right direction.
Thank you, Rakesh. Now, in a very short, the concluding remarks by our, I will say, host team, because IASB is hosting it and he's the vice chair of that IASB. So I'll request the concluding remarks from Sanjeev bhai.
No, I think Pramod bhai, the issues have all been well deliberated, and the overarching theme is that EBITDA is a better term than operating profit, and for the consistency in the cash flow statement as well, and maybe the word unusual be replaced with exceptional items. So and the reconciliation of the non-GAAP measures are given in the notes to the accounts, then a reconciliation with the GAAP measure. So that's been the overall theme. And since it's already been deliberated in detail and we are running short of time, I would like to express my sincere thanks for moderating such a wonderful session.
It was so yes. Nice, sir. I had wonderful panelists, Rakesh Agrawal ji, Shankaraya ji, Yagnesh ji, I would say Amin Siani ji, and my vice chair, Sanjeev Singhal ji. Thank you very much. Over to you, Yagnesh bhai. Thank you very much.
Thank you very much. What a great deliberation, and making me impromptu panelists. Thank you so much about it. And now we have the panel 2. Panel 2 is going to discuss the issues concerning connecting users and preferences. disclosures, GAAP and non-GAAP measures. And we have the moderator for the panel 2 discussion in form of Dr. Ashok Haldia, member ASB and the former MD and CA for the PFS Limited. I'm going to introduce the panelists in brief. Dr. Ashok Haldia is the SOKM nominee on the Accounting Standard Board and has served the CA profession as the former secretary of ICAI. And so he's well versed with ICAI. He's a part of ICAI family and the former MD and CEO of the PS Limited, founder and the managing partner. Then we have Mr. Rajesh Sehgal. He is the founder and the managing partner of the Equanimity Investments and has a deep understanding of the Indian entrepreneurship and the innovation ecosystem. He's an active secondary market investor since last 24 years, more than 2 decades. And then we have none other than CA PR Ramesh. Rameshji has been, I know him since last at least 15 years. He is a former chairman of one of the leading accounting firms, Deloitte India. And he has a rich knowledge of accounting and the financial reporting, and he has contributed to the profession and contributed to various technical committees of ICAI. उनका सहयोग ICAI में काफी बड़ा रहा है, योगदान काफी बड़ा है. He has also contributed towards various regulatory bodies like IRDA and even NECAS. And we also have Mr. Ramesh Karunakaran. He is the director of the rating criteria and the new product development. He is from CRISIL. Role to ensure that the rating division has the robust criteria development framework, and earlier he was working as a lead analyst and S&P analyst. Friends, I must tell you something about these all panelists. इनके लिए ऐसा कहा जाता है कि उनका सानिध्य, their association, even if you listen to them for even 1 hour, it is as good as spending 1 month in a university or in an MBA college. So I now invite moderator sir, Dr. Ashok Haldia, to take over the charge and start the briefings. Dr. Saab, it's over to you now.
Dr. Haldia, you're on mute.
Dr. Saab, you're on mute. Please unmute yourself. Yeah. आपकी आवाज बुलंद कीजिए, sir.
Thank you, Mr. Yagnesh and Sanjeev, and also the Accounting Standard Boards. Good afternoon and good evening to ladies and gentlemen. It's a great pleasure to be here again. We had presentation and discussions with the standard setters and the preparers of the financial statements. The standard setter giving its perspective as to how the standard should look like, and the preparer of financial statements, I was hearing Mr. Shankariya and Mr. Rakesh as to how the financial statements should enable them to communicate what they would like to the users of the financial statements. And they also underline the inherent limitations of the financial statements in doing that. Ladies and gentlemen, we now have the user's perspective. We have the users of the financial statements, and the users of the financial statements are also equally interested into effective communications. But while that happens, they would like a sense of prudence and sense of fairness prevails while reporting the financial statements. So that's the two, I'm not saying conflicting objectives, but these are the two objectives which needs to be reconciled, which needs to be balanced in order to increase the effectiveness of the communication. It's not the new problem that we are talking about today. The Sarbanes-Oxley Act in 2002 did highlight this problem as to how these the non-GAAP performance measures are creating distortion and misleading the users of the financial statements. 2003, SEC came out with certain framework as to the conditions for using the non-GAAP measures, and that was again revisited and redone in the year 2016, and they came out with a new set of far more strengthened set of conditions to be applied by the companies when they use the non-GAAP measures. Now we see the trends that has increased in the use of these measures. From 50% 3 to 4 years ago, 97% of the companies use extensively and intensively the non-GAAP measures. And the problem arises when you find that the EPS, as the financial statement would reflect, would be 10 times lower than the EPS that would be worked out based on the non-GAAP, the measures. So EPS for the management reparations would be as high as 10 times the EPS for the EPS calculated from the financial statement. Now there could be merits, there could be demerits. Users themselves would like to know much more and much beyond, and also at times much beneath the financial statement. So they have the information need, the company needs to provide. Now how that need can be provided into a transparent manner, what are the problems and how those problems can be addressed to, is this a standard which has come, which is an exposure draft. And in India, the SEBI, I would not comment upon, but we do not have a framework like SEC. What SEBI requires is that as an auditor, you only need to comment upon the financial information which has been drawn out of the financial statement, whether it is in accordance therewith or not. Now, from that perspective, this panel is important to see as to what extent these needs to be disclosed in order to meet the information needs, in what manner this disclosure can be fair and be transparent. There is a view of the preparers of the financial statements, there is a view of the users of the financial statement, and believe me, at times you are baffled when you look at the financial statements as to what is that is sought to be communicated, what is that is sought to be fed into the eyes and the minds and the hearts of the users of the financial statements. So with this, it's a very contentious issue, and we have a very distinguished panel. PR Ramesh is a very well-known face in the profession, and we have Mr. Sagal, who heads the venture capital fund, and then Mr. Ramesh Karunakaran, who is a director in a credit rating agency. So a diverse viewpoint, and I'm sure discussion today, a contentious viewpoint and argument against each other viewpoint would make this session live, and possibly live to the extent that the audience can remain alive till the end of the session. So Mr. Ramesh, if I can pose to you first, what is the need for disciplining, and to what extent that discipline needs to go when the companies communicate those performance measures to the world outside through something which is maybe through the financial statements, which is maybe beyond the financial statements. Yes, Mr. Ramesh.
Thank you. I didn't realize that I would be the opening batsman, but nevertheless, let me respond to the question you asked. But before doing that, I would also like to make some initial remarks in relation to this whole project. This project has a fancy title. And it has a voluminous 264 pages document which is there. Typical of accountants who produce a lot, which is good for the logging industry and not good for anything else. In my view, this falls far short of the intended objectives of the project. This is like arranging chairs on the deck of a Titanic. The Titanic being the financial statement reporting, which is sinking itself, losing credibility every day. And what we do is, rather than use an opportunity to do one of two things. You can do an incremental change or you can do transformational change. This, in my view, is neither incremental nor transformational in big time. We are only rearranging and saying, okay, show these few line items and report management performance. And therefore, before I get into a whole comments on that, which is not the question you asked me, we need to ask ourselves as to why is there diversity or why is there non-compliance. We can't just, if you set a standard which is outdated, if you set a structure which is irrelevant, if you read the book, which is written by Baruch Lev, and the title of the book itself is classic. It is The End of Accounting. That book is a research study and very clearly lays down that all what you produce in terms of financial statements do not impact markets at all. That's a research study of over 60 years looking at the New York Stock Exchange, I think, and comparing it with the price before and after published results. So the reality is we think that this adds value in terms of rearranging any of this? No. So what happens is people try to project the real value. People try to project what is relevant, and we take it as that is indiscipline. You need to be punished. You need to follow exactly this. So I personally believe more than disciplining, the time has come for us to really revisit the standards properly and ensure, because as they say, financial statements, the shareholders don't read it, the analysts don't need it. Because all the questions they ask in analyst meet, nothing is in the financial statements. Then we need to ask ourselves, why can't we have those in the financial statements? So let me pause here with that opening remark so that then see the reactions and let's go forward.
No, Mr. Ramesh, you said end of the accounting. I would say possibly evolution of the new accounting. You are entering towards the evolution of new accounting.
I hope so, but not with this standard, for sure.
Yes, and this standard, as you rightly said, is an outdated, something which was started in 2002 and something which was visited in 2016 is possibly is sought to be brought into the format of a new accounting standards in the year 2020. So certainly it doesn't meet that expectations. Now, from that perspective, Mr. Ramesh Karunakaran, you are a credit rating agency. Your job day in, day out to look into the financial statements, look into what is being fed to you, what is reliability, what is to be looked into and looked beyond. Do you think the financial statements, those are prepared as per the gap and given to you by the rating companies, meet your information need? And the information that you ask in addition, do you feel that if the financial statements or the format, if that is improvised, can meet your information needs?
You are muted.
Mr. Ramesh?
Yeah. Good afternoon, everybody. So I'll start. I will give
Are you or Mr. Ramesh, are both of them speaking from USA? Because both of you have the same background set.
No, I was inspired by Mr. Ramesh, so I chose that.
Yeah.
So I'll just give a brief on how we approach ratings. Ratings is ability and willingness of a company to meet debt repayments without any delay. So it is just not based on a past track record of a company, but it also, we try to embed some kind of a future information. How this future information is embedded, we try to meet the management. When we arrive at a final rating, what we look at is purely a benchmarking exercise where we compare and contrast the company's business and competitive strength with that of the entire set of participants in the market. So now, if you look at it, given such an exercise, rating analysts require a gamut of information. Typically, all such information is not available in the annual report. First of all, what we look at is we don't look at only a company as a whole. Suppose a company is operating in 2 or 3 major segments. Then what we look at is try to create a separate P&L for each of the segment. And then we look at it. Say, for example, if there is a steel company and it operates, in 2 or 3 different segments, then we try to segregate into the segments into various revenue, EBITDA, and PAT, and the capital allocation. So then we look at how efficient that particular segment operates. So this is a very critical information. What happens typically is that when we look at a company, majority of the times we don't get this kind of a segmental information. So that is a major drawback. Second, what we look at is, one of the critical information that we look at is the subsidiary information. For example, a company may operate with several subsidiaries, but what will happen is we will not, we will like to get some of the critical information about one particular subsidiary where it contributes significantly in terms of economic value. So that information is also not typically missing in the annual report. So these two aspects where the segmental information plus key subsidiaries information will play a critical role. And as was discussed before, EBITDA is a very popular terminology we use. I mean, in ratings, in CRISIL, or in the ratings world, if you go, I mean, if you the first question that anybody will ask you is what is the EBITDA, what is the EBITDA margin, or what is the debt to EBITDA, or EBITDA per ton. I mean, that is the key that we start with. So given this kind of a thing, an EBITDA combined with the various operating parameters, I mean, such as capacity utilization and cost per ton, etc., that would serve a very important role, because in ratings, cost analysis is an extremely critical part. For example, in manufacturing sectors, it is the cost that decides the ability to withstand the external vagaries. So that broadly sums up. I mean, you would like to have more on segment information, a segmental P&L, and also subsidiary related information, which is currently now very sketchy. Along with that, the cost-based parameters will also be very useful.
Mr. Ramesh, you talked about the EBITDA, and okay. I heard the earlier panelist talking about the EBITDA as well. I had occasion to read a detailed report and survey on the EBITDA in the Financial Times, and it possibly indicated the games that the preparer of the financial statements play with the figure of the EBITDA. And that's a detailed exercise, and that's what is possibly my next question after Mr. Sehgal's response. Is the response of the ED that EBITDA they would not like to discuss in this standard? Was that appropriate? That's the next question that I'll take. But Mr. Ramesh, I often hear that the rating agencies say that this is, I mean, that's not their fault because they relied upon what was given in the financial statements. So if you feel the financial statements are not good enough to communicate, then there lies the problem. And as a rating agency, won't you like that to be addressed through the effective communication, a project like this EDs?
Sorry, yeah. Yes, I mean, a lot of times we do face this kind of an issue where, I mean, the EBITDA typically, I mean, the companies overstate or kind of understate. But what we try to cross-check is, I mean, we have various checks and measures also. Like, for example, operating income to gross block or EBITDA to gross block. We do a, considerable check across various companies. So typically this pops out. But what we would like the management to communicate is, along with the EBITDA, connect the EBITDA with several operating parameters. That would be a useful measure for us to find out any issues. Say, I would like to give you an example. Typically, recently we came across one company where the operating income to gross block was really very high. I mean, we were not, we compared it with several other companies. It was, we were not able to really substantiate that company's operating income to gross block. We come to know that this company is kind of over-reporting its numbers. So that is one way we find out. So when a company typically gives many operating parameters along with the EBITDA, and that they report as part of the management discussion, that will be quite useful for us in kind of finding.
Certainly, that's what they need for, better communication or effective communication through the financial statements. Now, Mr. Sehgal, you had a venture capital fund. Now, yes, I often hear, and my interaction with the private equity fund and the venture capital funds is that financial statement is only one of, I will not say not significant, but one of the many information that they look, and their decision is not dependent much on the financial statements, but on many other things. Now, do you think the financial statements can be strengthened to better communicate to the users like you so that they can become more dependable, more reliable, and you believe on what the financial statement says?
Yeah, I think that's a very valid point of view, which we battle with regularly. But so I think why venture capitalists and private equity guys feel that way is more because of the kind of companies or businesses they deal with. So by definition, if you're dealing with a mature company, then there's a lot of information that the financial statements and all the other statements that the management puts out, they carry. But when you deal with companies which are very early stage in their own life cycle, then there is so much information, only very limited information that financial statements can continue. But that said, I think the struggle, that this whole panel today we are having, I think the struggle is between the accounting numbers and the economic numbers. I think as investors, what we are more focused on is not the accounting earnings or what the accounts have to say. As investors, we are more focused on the economic information that those numbers carry. So, I'll just pick upon the EBITDA conversation that we had earlier, and it's one of the glaring gaps will be advised to really capture the essence of EBITDA and put out some number or some total there, which reflects EBITDA. The reasoning that they put forth for not capturing EBITDA is that there is no one definition. But I think therein lies the opportunity for the Accounting Standards Board, that this is an opportunity where you get to define what EBITDA is and let the whole world around you then define their adjusted EBITDAs. It's like defining earnings or profits that we have, and then the whole world, all CFOs, all management teams are busy putting out adjusted profits and adjusted operating profits. So I think it's the battle is between the accounting numbers, the accounting information that all these financial statements carry, and the economic value that investors like us are seeking out of it. So it will be amiss to say that financial statements don't carry too much value. I think they are in fact very valuable. But to make it more valuable, they have to steer more towards the economic reality rather than just accounting reality.
Yes, Saigal, the point that you made out, I'll just give two comments. When you said often the financial statement of reputed companies and try to make a difference, but possibly we find problem more with the financial statements of the reputed companies. The second point that you raised, and which refers to what Mr. P.R. Ramesh said in the beginning, the conflict of identity of the financial statement. Do they indicate the accounting information that is historical, or they do reflect the economic reality? The effort, since the 2000 or the late 90s, was making the financial statement to reflect the economic reality. That in fact has not happened. So coming back to you, Mr. Ramesh, P.R. Ramesh, is that first you can talk on that, because 20 years we have made enough efforts to make the financial statement reflect the economic reality. We have possibly made it more complex even in that. And secondly, as the panel earlier was saying, Mr. Shankaria pointed out in the earlier statement, even if you ask the companies to give these performance measures, how do you ensure the credibility of those measures? Do you ask the auditors to verify? Do you ask the auditors to give certifications? And how cumbersome this is going to be, and how do you ensure then it is not only the performance measures? I'll come to the another aspect later on, but first these two questions, if you can respond.
Yeah, I think starting from this whole issue of EBITDA, I think it's not just an opportunity. Mr. Sehgal spoke very well, and he explained it, saying this is an opportunity. In my view, the standard setter, the accounting body has failed. If the standard setter doesn't rise to the occasion to give the definition, who else will? And in the same breath, the standard setter says that diversity in practice. There is diversity in practice merely because you don't define. If you lay down a definition, at least there is an issue of compliance, and they're going back on that. And then to touch upon this issue of this 20 years and all of it, if you look at the last 20 years, what have we done? You're right, we have made it more complicated. We have made it more confusing. We had one P&L, which we now call the statement of profit and loss. Then we said, no. let's break it up into, we introduced fair value in a big way. Then then we broke it up into other comprehensive income. In that further, we said items which will not get recycled to statement of profit and loss, items which do get recycled. To the ordinary user, what does this all mean? And he is absolutely right. Mr. Sehgal is right. How can you even distinguish economic value when you start doing this? Something gets recycled to P&L, does not get recycled to P&L. When will it get recycled to P&L? How? So I think, and it is something like, in my view, what we have done, and even in this whole project, is to say that, look, there is a measure of performance and of your health, let's say measure of your health. Temperature is the measure of your health. We recognize that lipid profile, all other things are important, but I'm sorry, we can't put it into that measure of health for a variety of reasons. So you deal with this, and if you want the temperature to be broken into different slabs, before food, after food, and all that, you can do that. That's exactly what we are doing. I think we have lost the plot. There's a lot more.
You know, again, Mr. Ramesh, you are touching some of the very, very original fundamental areas. I remember when I used to work with the government of Rajasthan, and somebody used to ask me what is the definition of various terms used in the financial statement. And I used to refer to a book of an ILO, remembering ILO, International Labour Organization. So what is that? What we lack is the terminology, and if the standards do not define those terminology, then possibly who else would be? Mr. Yogesh, just I know that we have a time constraint. Just another 5 minutes, we will finish it up.
Thank you.
Yeah. So, that's a major problem, and possibly that is what the accounting standard setters needs to look into. Now, if Mr. Sehgal, if I can ask you, as to you pointed out what you need most. Now, if I were to ask you 3-4 major non-GAAP measures that you like financial statements to cover, what is those 3-4 GAAP measures would be? Mr. Sehgal first, and then I'll come to Mr. Ramesh Karunakaran.
Yeah, I think there's, as simple as we think all this is, it's really, really complicated. So, all of us on this panel, we do appreciate the challenge that the board has when they're setting all these standards. So when somebody asks me, what are those 3-4 things that you want, that will help you in analyzing companies better and making better investment decisions, I'm really at a loss, because there are so many different industries. Within those industries, there are subsectors, etc. And each of those business profiles vary, from little bit to each other to varying a lot. And therefore, to just straitjacket them may not be the right way ahead. And therefore, I kind of understand what the board is trying to do here. But that said, you look at how the index is formed, the MSCI or any other index, and they have similar challenges, right? There are different, industries, different countries follow different standards. They classify companies, in different buckets. For example, just to pull up something that I remember. So, Tata Motors in India, everybody would say is an auto company, but for a long time, MSCI didn't classify that as an automobile company, by the way. So there are all these challenges, and I think coming back, taking that example and applying it here, I think what will help us a lot as users of these financial statements is if there are certain guidelines that companies have to follow if they fall within a certain sector. So, for example, if you're looking at comparing pharmaceutical companies in India to other pharmaceutical companies, are there 3 or 4 parameters which are non-financial parameters, or these are parameters that help us understand the performance of managements better? Then I think all pharmaceutical companies will be advised to at least follow those in spirit. Same would go for different sectors. So my approach or my recommendation here would be, rather than having a standard, it should be more in the form of a guideline for different sectors. And that, I think, will go a long way to help all of us.
What you are suggesting is to possibly follow some pattern like sustainability reporting standards. So you have for different industries, you have a different reporting format. Mr. Ramesh, if you were to have Mr. Ramesh Karunakaran, if you were to give some advice to the ICAI when they respond to IASB on this standard, what would be that advice that you would like to give?
Yeah, so I mean, I would like to go with what Rajesh has indicated. I mean, when you look at the sectors, and I try to compare one sector, one company with another company, the way they report in terms of the various operating parameters are very different. So rating being a benchmarking kind of an exercise, it is very difficult to compare one company with another company. So some kind of guidelines where I mean the companies together cooperate and then kind of publish a similar kind of operating parameter, that will be very helpful. Apart from that, I just want to highlight some other aspects also in terms of the reporting. For example, debt repayment is a very critical information for rating agencies. But typically what happens is that the debt repayment itself is missing. I mean, for the various debt that is presented in the annual report. This makes all the analysts literally plead for information with the company. So some kind of, detailed debt repayment, debt-wise, will be very important information. Similarly, even the CPLTD numbers are missing. Or combined with the current liability, that also can be given for the analyst to get a better hang of the debt repayment abilities. These two.
Yeah, thank you, Ramesh. Yeah, I think I've been getting reminders from Mr. From the.
Yagnesh has been busy.
Yagnesh. Yes, and so I would last words to you, Mr. P.R. Ramesh. With your experience of accounting, dealing with the financial statement as an auditor in India and also with the financial statements outside India, what is that, in a few words, your advice to the standard setter? The advice that I received from the earlier two speakers is that these are general purpose financial statements, but then you need to also address to the industry specific information needs. What would be your advice?
Yeah, I think, when you're dealing with financial reporting, at least there are these three things, which is measurement, presentation, and disclosure. And not on recognition. Recognition comes even before the measurement issue. Having said that, if you will, what is in the pipeline in a way is amendments to Schedule 3. We are trying to incorporate some of those into Schedule 3, which is not a complete solution, but it's some part of a solution in trying to address what Mr. Karunakaran said in terms of debt repayment in some ways. But more importantly, what are the challenges today insofar as financial reporting? It neither has confirmatory value nor it is predictive value. It's somewhere in between, a bit of both. And we have had corporate failures, so can it have some sort of signals for failure? Can it have indicators of performance? Therefore, ratios are being introduced. And of course, IASB says a ratio is not management performance. That is where the failure of a board, which says management, which uses fancy terms like management performance and then says these items are not management performance. So having said that, I think we need more evaluative information inbuilt into financial statements, whether it's ratios, whether it is many other comparable, whether it's comparable with benchmarks.
I think if you do not finish, Yagnesh would switch off the mics of all of us.
I think Dr. Saab could see me. Could read my.
Let me just add to what Mr. P.R. Ramesh said, that this panel gives a very useful, very critical inputs to the IASB, and I'm sure the IASB would take note of this. And I'm sure they would get in touch with all the panelists here individually later on to get their feel as to what, as a user, they would like the standards to be. But I would say towards the end that we should not only look into what is contained in the financial statements, we should also look into in what manner what is contained in the financial statement is communicated. It is user-friendly. If it is user-friendly, it can only then be effective. If the financial statements information there is packaged in such a manner, it is difficult to read, it is difficult to comprehend, then this is no financial statement that carries no meaning. And I believe if a financial ratio is not a measure of measure of management performance, then what else would be the measure of performance? There are challenges in terms of defining a particular terms. There are challenges in calculating those, but all those challenges with certain amount of flexibility given to the preparers of the financial statement and more disclosures available therein possibly can be effectively addressed by the standard setters. I have many anecdotes to share what really the financial statements are being used, and the games there is. I mean, I often call it the games that the preparers of financial statements plays with the users of the financial statements and the informed users like rating agencies or Mr. Sehgal tries to counter the games that the preparer of the financial statement plays. If we know these two arts, then possibly we would be able to set standards wherein these two players, these two part of the standards are not required to play the games that they play. With that, thank you very much, ladies and gentlemen, and possibly the distinguished faculty that we have or the panel that we have. They have made these discussions very lively, and I'm sure they tried the audience to be still alive as possible, even during the wee hours of the evening. Thank you very much.
Thank you. Thank you, panelists, and thank you, moderator Saab. It was so absorbing that I was feeling guilty to stop you. माफी चाहता हूं आपको रखने के लिए, but घड़ी की सुइयां कह रही है कि अब जाने का वक्त आ गया.
Standard setter agar
thanks everybody, thanks. So I had no alternate but to, I mean, beyond my wishes, I had to say no to him. And apology for that. Sir, before that, I just conclude in just 2 minutes. I like to draw the attention of the speech of the IASB chairman, Mr. Hans Sugawat. He was delivered the speech in somewhere on 17th of March 2020. And at that point of time, he has mentioned about the Tesla financial statements. But at the end of the his summary speech, he had mentioned, मैं हिंदी में कहूँगा तो मजा आएगी, फाइनेंशियल स्टेटमेंट तो इसकी अहमियत तो रहने वाली, उनकी अहमियत तो थी, आज भी है और रहने वाली है. फाइनेंशियल स्टेटमेंट इम्पोर्टेंट
अगर हम समय के साथ चेंज करेंगे तो रिलेवेंट रहेगी, नहीं रहेगी.
नहीं. So is going relevance of financial statement was there, is there today, and is going to remain in India.
जब तक कंपनीज एक्ट में है तब तक तो रहेगी.
And the best part of the panel too was it was dominated by 3 R's. 3 R's. Anyway, I'm grateful to the ICAI IASB board for giving me an opportunity to be an MOC, and also my friend Vice President Nehar Niranjan Jambusira ji for pushing up and giving me the moral support, and IASB Chairman and Vice Chairman, and even Vidya Jadi. So with this, now I invite the Vice Chairman, Dr. Sanjeev Singhal Sahab, to give the concluding remark. जिसे हम कहते हैं the packaging, the concluding remark, the culmination of this. It was a wonderful deliberation. Friends and participants, the viewers, मेरी एक ही आपसे हिदायत है. I implore you to please give your suggestions, ask your friends to give the suggestions, and please support ASB's endeavor to give its best contribution at IASB. हिंदुस्तान की यहाँ पे feel होनी चाहिए कि yes, Indians are intelligent and they do contribute. Thank you so much, sir. So, Dr. Saab, please, over to you.
Thank you very much, Yagnesh Bhai. It was a very, I was also spellbound in this whole panel, and I was also find it difficult that, the discussion was going on so nicely that to put a stop to it. But since time has to be respected,
मुझे विलन बनना पड़े, इसलिए क्षमा चाहता हूँ.
My apologies to this, and I think we had very useful discussions, and the overarching things which I said at the end of panel 1 was that some changes are required in this approach, and in panel 2, I think most of the panelists were even more clear that this is not going to serve the purpose. This is only a tip of the iceberg. And also the relevance of financial statement, which was being discussed, since I also had the sustainability reporting standard board. So my feel is that the future is going to be for the integrated reporting. So while financial statements will remain relevant, however, the non-financial information or long-term value is going to be of equal importance, and very rightly so. We have seen in this global pandemic what is happening when we are over-exploiting our earth. We are consuming the whole earth resources by 15th August. The annual resources we are consuming in 7.5 months So we are borrowing from the future years and future generations. So that cannot continue for long. The emission levels have already reached at an alarming level of 408 gigatons. I think the limit is 450. So we cannot afford to go in the manner in which we are going. The road ahead for this will be that we'll be requesting the companies for a dry testing. I mean, if they can actually convert their financial statement according to the exposure draft, that will be useful. And if we can also receive comments from the panelists, the participants, of course, as far as the suggestion of Dr. Haldia is concerned, that we must invite comments from all the panelists. So all are very esteemed panelists, and two of them, whether panelists or moderator, Dr. Ashok Haldia and Yagnesh Bhai, they are already a member of Accounting Standard Board, and PR Ramesh sir. Please feel free to send your suggestions, whatever you want, and the same with the other two panelists as well, and to the participants as well. Please send your comments. If we feel very strongly that changes are required in this exposure draft, we must express ourselves. And at the IASB, we don't have any firm view as of now that we want to go in a particular way. Whatever will be the voice of the profession, that is the sentiment that we will carry to the Accounting Standard Board. So that I can assure you. And thankful to all, thankful to the IASB staff led by Vidyadhar Kulkarni. Thanks to my MOC Yagnesh Desai. Thanks to Dr. Ashok Haldia for being the able moderator of this session. The job was not easy when the three stalwarts were there, and to all the all the three panelists. This was a wonderful discussion in panel 2 as well as panel 1. And I would thank my chairman, MP Vijay Kumar, President Atul Gupta, and Vice President Nehar Jambusareji. Thank you very much.
Thanks, everybody. Thanks, everybody. Thank you.
You're actually working on changing the look and feel of the thermometer instead of treating the ailment anyway.
All right, thanks everybody.
अरे रमेश जी, संजीव जी कह रहे थे कि सस्टेनेबल रिपोर्टिंग के साथ इसको इंटीग्रेटेड कर दो. हमारा लाइटर सेंस में ये है कि अभी तो फाइनेंशियल सिस्टम में कोई समझ नहीं पाता. सस्टेनेबल रिपोर्टिंग साथ में कर देंगे तो फिर कोई देखेगा भी नहीं.
सर कुछ लोग OCI भी नहीं समझ पाते सर.
OCI तो Government of India has already introduced long ago, right?
Thank
Overseas citizens.
Yes. Thank you.
Thanks.
Thank you. Thank you.
Thanks.
Thank you.